Welcome to The Explainer. Today, we're diving straight into how a single property acquisition in Singapore reveals a massive structural shift in the global economy. This isn't just a story about a building. It's a masterclass in understanding exactly where the big money is moving right now to find both security and explosive growth. So, you might be wondering, where exactly is the smart money hiding from inflation these days? Well, to figure out where institutional capital is flowing to find safety in today's unpredictable, high-rate economy, we have to look closely at a sector that honestly used to be pretty ignored. We're talking about the gritty, highly functional, and totally unglamorous world of industrial real estate. Here's our roadmap for today. We'll start with the $133.9 million deal, then look at the shift to vertical warehousing, dive into the financial strategy, and finally, zoom out to the global logistics boom. Let's get right into it. Part 1. The $133.9 million deal at 5 Tuas Avenue 5. The big headline number you really need to lock in here is 133.9 million Singapore dollars. CapitaLand Ascendas REIT just formally agreed to drop that massive sum on a single industrial asset, with the deal expected to officially close in the second half of 2026. But it really makes you think, right? What exactly does that kind of cash buy you in today's market? Well, it's not just some dusty, empty warehouse waiting around for a tenant. It's a state-of-the-art, 7-story logistics development right in Singapore's incredibly constrained Tuas zone, which is a critical hotspot for advanced manufacturing. It's practically brand new, having just been finished in 2021. And here's the real kicker. The seller, Hupin Transport, is actually staying on as the occupier. So you've got strong tenant retention and immediate, reliable stability baked right into the contract. Moving on to part 2, the vertical warehousing shift. Basically, building up instead of out. Now, why go through the trouble of building a massive 7-story warehouse instead of just sprawling outwards like they used to? It all comes down to a really brilliant structural design known as a ramp-up logistics facility. See, instead of relying on slow freight elevators that completely bottleneck operations, this multi-level building has heavy-duty vehicle ramps built right in. Imagine massive delivery trucks driving straight up to the upper floors. It's a total game changer for keeping things ultra-efficient in tight, super expensive urban environments. And you really have to understand what's driving this architecture. Look at our own shopping habits. The explosion of e-commerce, combined with a severe lack of land in key markets like Singapore, is quite literally forcing the supply chain to build toward the sky. Throw in the desperate need for advanced manufacturing infrastructure, and honestly, vertical warehousing isn't just a trend anymore. It's an absolute necessity to keep the modern economy moving. Okay, section 3. Let's talk about the financial strategy behind this. Disciplined pricing and yield. Let's look under the hood here because the numbers are fascinating. The agreed purchase price is $133.9 million, right? But the property's independent valuation actually priced it higher at $136 million. By snagging a 1.5% discount right off the bat, CapitaLand Ascendas REIT is showing some serious discipline. It proves that even when the market is red-hot and highly competitive, these institutional buyers are ruthlessly prioritizing financial value. But here is the absolute magnet for all that capital, a 6.6% yield. They're projecting a 6.6% first-year net property income yield, and that's before transaction costs. In the commercial real estate world, pulling that kind of immediate return from a brand new prime asset is exactly what portfolio managers are desperately hunting for. And let's connect the dots on why that matters so much right now. I mean, think about it. With global interest rates creeping up and inflation eating into profit margins, securing a predictable 6.6% yield is how these massive institutions build a fortress around their money. They are heavily prioritizing stable, inflation-linked cash flows. Income-generating logistics assets like this one, they essentially serve as financial shields against a really unpredictable global economy. Which brings us to part 4, the global logistics boom, and what we're calling a structural re-rating. Because, listen, this single $133.9 million deal in Tuas, it's not happening in a vacuum. It is a glaring symptom of a massive global trend. All across Europe and Asia, listed REITs and major institutional investors are rapidly recycling their capital. They're literally yanking money out of older traditional property sectors and aggressively pouring it into high-efficiency logistics parks, data-enabled infrastructure, and these hyper-modern urban distribution hubs. What we are witnessing here is a fundamental, structural re-rating of industrial property across institutional portfolios.
Industrial space is definitely not the forgotten stepchild of real estate anymore. Deals like this prove that REITs are acting as the primary capital allocators today, actively reshaping our entire commercial landscape to fit a high-speed, delivery-driven global economy.
So, as we wrap up this explainer, it leaves us with a really fascinating thought to ponder. Are physical warehouses actually becoming more valuable than those shiny traditional office skyscrapers in the modern institutional portfolio? As we rely more and more on e-commerce, and as urban land gets scarcer by the minute, are these advanced multi-story distribution hubs officially the new crown jewels of global real estate? It's a huge shift in how the smart money values physical space. Thanks for tuning in. And hey, the next time you see a massive warehouse going up, you'll know exactly the billions of dollars moving behind the scenes to put it there.